Hi, my name is Jim Benages, and I'm a financial consultant with Alliant Retirement and Investment Services. I want to thank you for taking the time to join me today and talk about the basics of investing, the path to confidence and empowerment. So today we are going to be talking about the basics of investing. Many people find it a bit challenging and get interested or engaged with investing and the planning and the strategy that comes with it. A lot of people find it just to be a very, very scary topic. So I do appreciate you taking the time. Hopefully you're going to take something away today that is going to make you not only a better investor, but maybe just put you down the path to investing at all. So before we really get into the presentation, I want to go over some of the resources that we have available to you. So webinars, just like the one I'm doing today, our advisors or our consultants host a multitude of webinars on many, many different topics, such as estate planning and Social Security, Medicare, income in retirement, some tax planning webinars. We really have a diverse topic lineup, and there's some great information. So if you're thinking about getting involved in investing, I highly recommend you check out some of our webinars because there are some great topics. We have a whole host of podcasts in our library. So if you're looking for different topics that you'd like to know about, make sure to check out our podcast because there's a ton of really good information that Tom and Christian have put together, and had some great guest speakers. So I highly recommend that you check that out. Last but not least is our website and blog. If you have the opportunity, I would definitely go to our website. There are some great resources there that really, if you're thinking about becoming that investor, they will help you down the path. Now, as far as today, what are we going to talk about? We're going to talk about, are you ready to invest? What are the things you need to think about before you really start investing? Talking the talk. What is the terminology? What is the jargon that an investor should know, right? You want to sound like you know what you're talking about. The 4 steps to becoming an investor. So what are those things that you need to do, or one of the things you need to know? And then at the end of the day, what kind of investor are you? So are you ready to invest? Now it's funny, right? What is your investing approach? So we find that people kind of fall into one of these 3 categories. But the funny thing is, over time, the way you think of yourself or the way you think of your investing approach can possibly change, right? So I'm going to tell you a story of a woman I talked to last week. So I've been talking to her. She attended one of my webinars in the past, and that's how I met her. And we've had 4 or 5 conversations at this point. But last week, I was speaking with her. Now, she started out as, I prefer to figure it all out on myself. She had an account with Fidelity. She had placed the majority of her money in bonds. She was handling it all. After our initial conversation and we decided to do a Social Security plan for her, she decided, I need a little guidance. So she asked me to take a look at everything that she was doing and kind of give her some feedback. So that was really our second conversation. Our third and fourth conversation turned out to be, please, can someone just take care of this for me? So she went from thinking she had a pretty good handle on everything, but the truth be told was she felt like she was potentially missing the boat on some stuff and she needed a little guidance. And at the end of the day, she said, I'm so stressed out over all of this. I'd really rather have somebody doing this for me. Now, here's the absolute funniest part. When I spoke to her last week, she went back to, I prefer to figure it out all by myself. And within 15 minutes, she was, maybe I just need a little bit of guidance and I'm good. And by the end of the 45-minute conversation, we were back to, please, can you just take care of this for me? So you can go through all 3 phases of your investing approach in one conversation potentially. My point is, folks, that things are going to change as time goes on. We're going to give you the basics. What your investing approach is going to change, especially when you get a little experience. So are you ready to invest? So this is a great question. And some of the things you need to think about aren't necessarily here, but I'm going to talk about them. So first of all, if you have a steady income, obviously you've got to have money coming in the door to pay the bills. But I think this second line is more important. You have money left over after meeting your financial obligations. Let's talk about that for a second. So I've had people come to me wanting to invest, and we have a conversation, and they want to invest, but they've got $25,000 in credit card debt, and they want to invest $5 a month, $10 a month. Realistically, you've got to think truly about your financial obligations as not only what your monthly payment is, but what makes the most sense financially for you to take care of first. If you're sitting on 20,000 in debt at 29% interest, that needs to be your first concern. And then we talk about investing. So it's not just how much money you have left over at the end of the month is that determination. You have to look at the big picture. Now, you've considered the effect of upcoming personal changes such as marriage, children, or divorce before investing, right? So my son graduated from college little bit just under 2 years ago. So he graduated from college, stopped having to pay that bill, which was a whopper. So me and my wife, life is a little bit easier, right? Yeah, he got engaged yesterday. We're super excited. We love her. We only have one child, so this is, we only get one chance at all this. So now, okay, now we got to start planning for how we're going to pay for this wedding and all of the things that are going to come along with it. My wife, I think in 24 hours, has the shower completely planned, if you can believe that. And I'm sure some of you probably can believe that. You definitely believe that if you ever met my wife, but I love her to death. So things change, life changes, the things you're saving for change, and you have to think about those things, whether it be college for your kids, an upcoming wedding. Hopefully you don't ever have to think about divorce. I hate being negative, but you have to consider your short-term needs and goals. And then you've got to build up a little bit of a safety net, a little bit of a rainy day fund. If you ever listen to Jim Cramer and the other talking heads, they'll tell you 3 to 6 months of an emergency fund is clutch, especially if you're a homeowner, especially as you get a little bit later in life. It never ceases to amaze me that life just happens. December, I was playing pickleball. Sure enough, tore my rotator cuff. Right, pickleball's the number one, is keeping all the orthopedic surgeons in the country real busy, and I'm just another victim of that. But that's deductible that now I have to think about. That's $6,000, $7,000, whatever the medical bills are going to turn out to be. That's a lot of money. You have an air conditioner that breaks down in the middle of the summer. It's 95 degrees out. That's $5,000 or $6,000. Car breaks down. You have to think about having that reserve so that you don't necessarily put yourself into debt, or you have to pull money out of an investment that it's not necessarily the best time to pull the money out in an investment. So you need to take all of these things into consideration before you even think about starting to invest. Now you've got to talk the talk. So knowledge is investing power. So there are so many resources online today. Really, it can be a little overwhelming, but I'm going to tell you there are some resources that I definitely like. Now, the Wall Street Journal app is phenomenal. You get really non-biased research, non-biased reporting. You get just a disinterested third-party view, which is not necessarily a bad thing. Now, I'm sure probably 98% of you have never heard of LPL or the LPL Research Weekly Insights Report. So at the end of this presentation, my information will be up there. If you would like to see the LPL Research Weekly Insights Report, I will be more than happy to get it out to you. It is great information. Again, it's just disinterested third party. But there are some other sources. CNBC does a good job in general of reporting financial information. Yahoo Finance is another good source. If you're looking for information on funds, if you're looking for actual investment information, Morningstar.com is absolutely free. There is some great information on ratings of funds, ETFs. There are a ton of good resources out there. So depending on your personality style, what you're looking to accomplish, I would definitely look and search out some of those resources and start reading as much as you possibly can. Talking the talk. So let's talk about some of the indexes. So the Dow Jones Industrial Average has been around since 1896. Now it consists of 30 blue chip stocks, and blue chip stocks are stocks in very, very, very large companies that have been around for an exceptionally long period of time. Examples as they listed here: Coca-Cola, Johnson and Johnson, McDonald's. Um, the criteria to be in the Dow Jones Industrial is that the companies are not only industry leaders, their size, and the reason why the Dow is structured this way is because of stability. Typically, when you get into these exceptionally large companies that have been around for an exceptional period of time, you don't get as much volatility. It's not to say that they're not going to go down. It's not to say that they're not going to go up. You just don't experience the same type of swings. You definitely will in a down market see the Dow Jones go down. But these large companies that have the stability, that pay the good dividends, you don't see them move as much as the smaller companies and the companies that are still growing. So that's one index. The next one we're going to talk about is the NASDAQ. Now, NASDAQ was the first exchange to offer online trading. Now, typically, the NASDAQ is weighted really heavily towards tech companies like Apple, Facebook, Google, and Amazon. They do have some companies that are outside of the tech realm, and they also have a wide array of size of companies. So not only are you in different market segments, but you're in different capitalizations. So you're not just talking about those exceptionally large cap companies. You have some mid cap and small cap, and some examples of those are Angie's List and 1-800-Flowers, Starbucks, Spirit Airlines. So all of those companies can end up being in the NASDAQ. But again, you have a little bit more diversification. There's one other index that I think I need to mention while I'm sitting here, and that's the S&P 500. The S&P 500 has been around since about the mid 50s, and it's made up of companies that, again, are exceptionally large, but it's a wider spread of companies. What I mean by that is the Dow has 30 companies, the S&P 500 has 500 companies. So the S&P 500 represents 80% of the publicly traded stock that's actually available out in the markets. So a lot of industry insiders use the S&P 500 as really more of a benchmark than either the Nasdaq um, or the Dow Jones Industrial. Outside of the S&P 500, you do also have a multitude of different indexes. You've got the Russell 1000, the Russell 2000. They focus on different size companies. Internationally, you've got the Nikkei, so many indexes internationally. So it's important to kind of know what they are so that you can track what the overall trend in the economy is. So if you're planning on jumping in, are you jumping in when things are very high? Are you jumping in when things are very low? Are you jumping in when things are calm? Are you jumping in when things are kind of all over the place, right? So that's why it's so important to pay attention to these indexes. I look at them every single day. So it's a good, and again, I like the S&P 500 if I'm talking in general. So it's a good idea for you to get to know these. And if you're really thinking about jumping in, I would start looking CNBC again. You can go in, look, it's real simple. There's really good information on there, and start paying attention to what's going on. So section 3, we've got to talk about the 4 steps to becoming an investor. So step 1, learn which investments are appropriate for your financial goals. So it depends on what you're trying to accomplish. If you're trying to save for retirement, if you're trying to buy a new home, if you just found out that you're going to have a wedding to pay for and a shower and all of those things, those are all things that um, those are all different financial goals that you've got to save for. So let's take a look at the different vehicles that you can use to save for those. Now, stocks. So let's talk about stocks and what they are. Stocks are shares or equity, basically ownership in a publicly traded company. So, for example, I worked for Chase years ago, and I was in the stock purchase program, and Chase is a publicly traded company, right? So I joked with my clients that I had probably had 200 shares of Chase stock at the time. I hadn't been with them for very long. And I basically said, I owned a pen of Chase, and that was basically all I owned. You talk about ownership of a company, but when you're talking about some of the size of these companies, like a Coca-Cola or a McDonald's or a Chase or an AT&T or a Johnson and Johnson, your little share of equity is minuscule as a comparison to the big picture or the total investment. But that doesn't mean that it's not a good idea and you can't make money. So with stocks, it's a high risk versus high return potential. So when you're looking at picking individual stocks, right? When you look at the blue chips, when you look at the McDonald's, the Johnson and Johnsons, um, those stocks don't fluctuate a lot. So even though they're still high risk, it's not you're not going to see the volatility. Being that you're not going to see the volatility, you're going to have a little bit more stability. You're not going to get the kind of return potential that you would potentially get in a Tesla or in Amazon. Even though those are big companies, they're still growing, right? So you've got to think what's appropriate for your long-term financial goals, such as retirement. I invest in stock 100% for my retirement. I don't have any fixed income in my portfolio. 52, I have enough time that I know that that's what makes sense for me. But stocks in a short-term investment, if you're 27, just out of college, just got married and saving for your first house, do you want to invest in stock for that down payment? No, most likely not. You want to make sure you do something that's a little bit safer. So let's talk about something a little bit safer. Let's talk about bonds. Now, bonds are used by companies, municipality, and governments to finance projects and operations. Okay, so let's talk about a municipal bond. Let's say your local library needs to build a new library. They just need to expand, right? A lot of homes, a lot of new construction in the area. So the way a bond works is your library district will come to you. Let's say they come to me and they say, "Hey, Jim, you got $5,000 sitting in savings. Give us your $5,000. And in return for you letting us use your $5,000 for, let's say, the next 10 years, we're going to give you 5% interest." Okay. So basically, I am loaning that municipality, I'm loaning that library district my $5,000. In return, I'm going to get a fixed interest rate. Let's say the interest rate hypothetically is 5%. So I'm giving them my $5,000. I'm going to get 5% on that for the next 10 years. Now, if I'm making this play for retirement, I'm 52, 10 years is plenty of time. I know I'm not going to need that money. 5%, even in today's market, that's a pretty decent interest rate for a 10-year commitment. I'm good with that. And am I worried that my library district is going to go out of business, that they're going to go bankrupt? They've got tax money coming in every single year. So I feel confident they're going to be able to pay the money back. So I give them my $5,000. They give me 5% a year. And then at the end, I get my $5,000 back, right? So your principal and stated interest get paid back at the maturity date. Moderate risk, moderate potential returns. 5% is not exciting. The only risk I have is that my library district is going to go out of business, going to file bankruptcy. There is a chance that that's going to happen, but I think the chance is relatively slim. It's appropriate for mid-range financial goals such as college funding, and it may make sense for your retirement portfolio as you get older and want a little bit more conservative guide point. But like I said, I wouldn't necessarily be using it in my retirement funds as a 52-year-old. I have a tendency to lean a little bit more towards the stock, but a good balance and diversification is important. We're going to talk a little bit about that, right? And then you've got cash on hand. So typically, money market funds, when we talk about cash equivalents, we're talking about checking, savings, certificates of deposit. They offer you lower, almost virtually, let's say lower risk, consistent returns, but the returns are lower, right? It's a fixed interest rate. You don't get as much bang for your buck. And I'm going to show you the difference in just a moment. They're appropriate for shorter term goals, such as saving for the down payment on a house. It's a perfect way to go. As you get later in life, I find more and more people want more and more in cash. When I talk about that rainy day fund, for a 30-year-old, 3 months in savings is more than enough. As you get later in life, there is some security, there is some peace of mind of having plenty of cash on hand just in case something comes up. The Before I get out of, the options you have as far as investing, the one thing that I think this presentation doesn't talk about that should be just brought up briefly are mutual funds and ETFs. Now, mutual funds and ETFs offer you the opportunity to invest in stock and bonds, but not have to invest in individual stocks or bonds. I think that mutual funds are a huge advantage, ETFs along with them, right? ETFs are a little bit cheaper way to invest. Mutual funds are a little bit more actively managed, but I find huge advantage in funds. And the advantage that I find in funds is you get a ton of diversification. Now, some of you have probably heard of this, but a lot of you have probably not, right? And that's Enron. Enron was an energy company. I don't remember what year it was, but it was back in the, I believe, early 90s. Energy company that had some kind of not very ethical accounting practices, and they came to light. And at the end of the day, went out of business. Well, Enron was a publicly traded company. Here's the reason why I like mutual funds, right? If you had $10,000 in Enron shares, Enron went out of business. You lost your whole $10,000. They were done. Publicly traded company that went out of business. Now, if you had Enron in a mutual fund or an ETF that had 150 companies inside of it, Enron goes out of business, you may lose 1, 2, 3% of that mutual fund, but the rest of the companies, the other 149 companies inside the fund, may be doing perfectly well. So if you're thinking about investing in stock, but the thought of investing in one individual stock kind of scares you, same thing with bonds. You're thinking about investing in a bond, but being locked in for a long period of time kind of concerns you. Mutual funds and ETFs are a definitive way to go to get yourself invested in both of those asset classes. So I definitely would look at them. The presentation doesn't really talk about it, but I definitely wanted to mention that. Now, we talk about risk versus return or risk versus reward, right? So top of the list, and I mentioned it, S&P 500, average annual return from 1985 to 2022 is 8%. You look at bonds, which, yes, offer you that safety net, a lot less volatility, a lot less risk, but you make less than half. Stable assets. Now, stable assets are your cash. So your cash, checking, savings, certificates of deposit, right? Already talked about these. On average, 0.4%. Hard to believe in today's market, not so hard to believe in 2009 after the financial crisis when interest rates were zero and were zero for years. You couldn't find yield in a CD to save your life at that point, right? So stable assets over time cost you. Here's the thing that you need to keep in mind as you're looking at investing, and that is inflation. And this is where a lot of people lose sight, right? Is if inflation is 2.74, and listen, we all know about inflation after the last 18 months that we've had. Gas prices going up, food costs fluctuating dramatically. One week I'm paying $5 for a pint of strawberries, and the next week I'm paying 10. It's crazy. But inflation overall on average is 2.74. If you're in cash, you're losing 2.34% a year because inflation is devaluating your money faster than what you're gaining is keeping up with it. So it's the reason why investing is so important is because it offers you the opportunity to definitely outpace inflation, um, and over time is going to make you significantly more money. So I've been saying it the whole time, right? Embrace diversification. You want to balance your portfolio with different investment options from different asset classes. I'm going to sound like a broken record, but again, this is why I like mutual funds and ETFs, because you can get a lot of eggs in a lot of different baskets, and it's there's a lot of funds out there that are exceptionally well managed. don't put all of your eggs into one basket. So investing in one stock can be costly if things go bad. And I don't care what the stock is, it can end up being a very, very costly mistake. So, lesson from Lifesavers Candy. Lifesavers Candy. What does Lifesavers Candy have to do with investing? So, Clarence Crane invented Lifesavers back in 1912. When he invented Lifesavers, the only flavor was peppermint. Okay. Now, a year later, Crane was approached by a gentleman named Edward Noble, and Noble suggested that Crane offer some different flavors. Man, peppermint is nice, but maybe people want a green apple. I don't know what your favorite is. Mine has always been the green, but everybody has a different flavor. I don't know about that pineapple flavor. Never been a big fan, but we all have our favorite flavor of Lifesavers, right? At the end of the day, Noble wasn't interested and just wanted to offer peppermint. Well, Crane ended up buying Lifesavers from Noble for $2,900. Now, $2,900 back in 1913 was a big deal. But Noble went on to build $1 billion business manufacturing different flavors of Lifesavers, right? He diversified the flavor portfolio. He diversified his flavor portfolio and got more people interested in Lifesavers. We all know we take the pineapple, we kind of throw it into garbage, and then we eat the rest of the roll. I'm just kidding. Don't pineapple Lifesaver lovers don't hate me. Okay. We all have our favorite. Joking aside, this is an example of how diversification had worked. So, understand how the economy affects your portfolio. So the state of the economy, or how the U.S. uses its resources to produce goods and services, greatly affect stock market activity. So let's talk about some of the trends, right? The bulls versus the bears. Now, here's the funny part about investing. So when you're a bull, when we're in a bull market, that means investor confidence is high, right? We're going to the moon. Things are exciting. We're taking it all the way. So when investors are confident and things are moving in the right direction, they're bullish. Okay. Now, then there's also a bear market. Bear market is when investors are nervous. Stock prices drop, many stocks are undervalued. But here's what I'm going to tell you. Initially, and it's so funny, because initially it sounds crazy. When I was studying for all the securities license that I had, there's all these theories on people buying high and selling low. And I said, who would ever do that? And then I became a financial advisor. And I find that 90% of people want to do that exact thing, right? When things are great, when the market is up at all-time highs, that's when everybody wants to get in. When the market has just absorbed a 25% loss, 2022 was a rough year. 2020 and 2021 were phenomenal years, right? So we were very bullish in 20 and 21. In 22, we were bearish. I like a bearish market. And here's what I'm going to tell you why. Is if I buy a stock when things are good, right? And I like that stock, or a mutual fund, and I like it, and I'm going to ride it out. What if I could buy it 25% cheaper? Why wouldn't you want the deal? And that's basically the opportunity that a bear market presents. Now, the scary part of a bear market is you have to go against everything everything your gut is telling you, which is you should be scared because things are down. But it really does present an opportunity, and you really need to change the way you're thinking when it comes to investing if you're doing this on your own. All right. Inflation. Talked about it a little bit. So historically, the cost of goods and services have always gone up. We've seen a little bit of an excessive inflation trend over the last 18 months. It's steadying. Gas prices have come back down. So low inflation typically is potentially good for markets. We saw that in 20 and 21, right? Because people have more money on hand. If things are costing less, people have more money, they can invest more, and that drives the economy. When prices of goods and services are going up, that's potentially bad for the economy. Why? People have less money to invest. Debt is going up rather than decreasing. So inflation can be a key indicator as to what we think or how you can plan out how the potential economy is going to move. Interest rates are another thing that greatly affect the economy. Now, they're controlled in most part by the Federal Reserve. So when rates go up, stock prices generally go down. Why? Well, because interest rates go up typically when inflation is going up. And interest rates go down typically when inflation is going down. So it's the same reason, it's the same reaction. So it's almost an inverse. Rates up, stock prices generally go down. Rates go down, stock prices generally go up. Okay? Good things to remember. And if you look at what happened in 2019, when the Federal Reserve ended up dropping interest rates 3 times to kind of stave off a recession because of what was going on with the pandemic and the shutdown of our economy, you saw that in 2020, stock market rallied. Actually, at the end of 2019, the stock market had a great rally. So all things to take into consideration. Now, seek professional help if you need it. Let me be your financial investment counselor. Okay, all joking aside, I'll put it on the table right now. I want to help all of you with your finances. I want you all to be clients. So now that I've said that and we've gotten off of the table, let's talk about really why it's important to talk to somebody, potentially a disinterested third party, to help you out. We can talk to you, we can get to know you and help you understand the different types of investments and their place in your portfolio. Where does this matter to you? We can help you determine your financial goals. We can talk to you about retirement and potentially how much money you're going to need in retirement based on what kind of lifestyle you want to have. If you're saving for a home or if you've got a child that you've got a college education to save for, we can give you some ideas on how to do that. If you want to start your own business, or maybe you just want to get better at budgeting and paying down debt, we can help you with that. We can help you determine an appropriate investment strategy based on your financial goals, your risk tolerance, and time frame. We can talk about things that potentially you're not going to have a lot of information on out there. And we can continue to meet with you over time to make sure that things are going well. Now, listen, even if you decide that you want to go with somebody local, whatever the case may be, it is a great idea to get a disinterested third party to help you sometimes and get some of these ideas mapped out, even though I know we do a fabulous job of it. You definitely, there's something to be said about getting some help. So, what kind of investor are you? Let's talk about what makes up a conservative, a moderate growth, a growth oriented or aggressive growth, investor. I'm going to use again myself. So, me and my wife, by the way, I'm going to preface this with me and my wife have a fabulous relationship. We've been married for 27 years. Obviously, we're a little giddy today because our son got engaged yesterday. And so we're super excited. But me and my wife, from a risk taking or a money perspective, could not be two more different people. Like it's the one area that we are just black and white. We're completely different. So my wife is, and I have hundreds of clients. My wife is by far the most conservative person fiscally I know regarding money. She is only within the last probably 12 to 18 months started using like rewards credit cards to pay bills and then just paying the credit cards off at the end of the month. I was like, you're missing on all the rewards. And she was just a cash person. She wanted to pay cash for everything. That was just the way that was just her modus operandi. So it's not a criticism on my wife. It's just the way she's built. She was raised by a single mother who was a waitress, and cash was king in her house. They didn't have any credit. They rented her entire life. She didn't own a home till we bought our first home. So she comes with a different mentality and a different background. I tell you this because right before our son graduated from college, we were sitting down chatting about just money in general, and we were kind of laughing that we were close to the finish line. And what are we going to do with all the extra cash? And we share with each other where we're at financially, but obviously I manage the retirement money and any of the investment funds. And she said, I want to sit down and I want to talk about how we're invested. And I said, no, you don't. And she said, no, no, really, I want to know. And I said, babe, you absolutely do not want to know. I said, I'll tell you, but you don't want to know. She said, no, no, I want to know. So we went out to breakfast. I brought all the information, brought all the statements, and we sat down and we talked about it. And we were sitting there for probably an hour and a half, and I was talking about how we're invested. And we got done with the conversation, and she said, okay, this is the one time I'm gonna tell you this. And you probably, maybe I'm never gonna tell you this again, but I'm gonna tell you this right now. She said, if I ever ask to see any of this stuff again, just tell me to shut up. You have my permission. It'll be the only time I'll be okay with you telling me to shut up. I'm like, okay, cool. And she said, I'm not going to sleep for 2 weeks now. And she said, I know you know what you're doing, but now that I know how much risk we're taking, I'm not going to sleep for a month. You have to think about, the reason I tell you this story is you have to think about yourself and you have to be honest with yourself, right? Because when you look at these different models, everybody's going to want what an aggressive growth model's performance is going to end up being. But if you've got a conservative mindset, you can't put yourself in an aggressive growth model because you're going to end up hurting yourself down the road. And you know, these models talk about how much cash versus fixed income or bonds versus stocks. I'll tell you, you know, I don't have a client in an aggressive growth model that has any cash to speak of invested. They got cash in a savings account as a, you know, their security blanket, but they really don't have any bonds. They're all 100% stock, and that's almost every aggressive growth oriented investor that I help. And then down the line, my conservative investors, the majority of my truly conservative investors have no money in the stock market, and that's okay. They're older. Uh, they don't need the growth. You know, some people get to the point where they just don't need the money growing at 8% a year. But as you know, as a 52-year-old, having, you know, having within the last 2 years just got done paying for college and now I got a wedding to pay for, yeah, I need the growth. I need my money working for me at this point. There'll come a time when I'll be okay. That time's not here yet. So you need to really ask yourself the question about what you really need out of this. And do you really, you know, how much risk are you willing to take on? How much pain you can endure? Again, speaking with a financial professional, you know, we can share some of our experience with you. We can talk you through um, what, you know, what aggressive growth, what the downside could potentially be for you, what the, you know, what the downside on a moderate portfolio could potentially be, what the upside is, right? On a good day, what are we talking about? What's the exciting part? You want to have all that information. So I'm not a big fan of the questionnaires. Everybody's questionnaire is a little bit different. I find it very impersonal. And I think it's a good, I think trying to figure out what your risk tolerance is, I think that's a good thing for you to have a conversation with, again, a disinterested third party that's got some experience that can really explain to you what the differences are going to end up being. So with that being said, I'm going to remind you, we've got some great educational resources, our webinars, ton of topics, um, phenomenal consultants presenting that information, very knowledgeable. So I highly recommend you check those out. If you're a podcast person, we got some great information out there. And again, if you just like to let your fingers do your walking on your own time frame and go at your own pace and do it when you want to do it, our website has a great amount of information. I can't tell you how much I appreciate you joining me today. Put my information up on the screen. If you would like to have a consultation with me, you can always feel free to reach out to me. I promise to provide you straightforward analysis. And I really, really appreciate you taking the time to join me today. I hope you got something out of it. I hope you enjoyed everything and have a fabulous rest of your day.